Thank you very much, Adam. Obviously, in recent years, retail's gone, through a lot of transformation, and with that comes different shopper expectations. That's obviously what a lot of people talk about. The difference is that not only do we have these shopper expectations, and something that a lot of people don't really consider is that there are also Wall Street shareholder expectations as well as analyst expectations that people usually don't really consider when going ahead with their retail strategies. So I have 3 financial analysts here through the retail industry who are here to discuss a little bit about what they see in the state of the industry today and going forward into 2018. So just to introduce each panelist, right here on my left is Charlie O'Shea from Moody's, and in the middle is Brian Nagel, who works at Oppenheimer and Company, as well as Simeon Hyman from ProShares. And just to kind of kick things off, can each of you just go a little bit into your position and just some of the sectors that you focus on?
Yeah, I guess I'll start. I work for Moody's, which is a rating agency, so we focus on the debt side of the equation, not the equity side. So you will hear us talking about terms like leverage, balance sheets, which are a foreign term to a lot of folks out there these days. And we physically rate companies. So we will put a rating in place from AAA down to C, which is our assessment of the risk for the company. We take a forward view, but history does matter. So my remarks will be structured around the debt side of the equation and the debt holders rather than shareholders.
And I work as a sell-side equity research analyst at Oppenheimer, covering what we call the hard lines and e-commerce sectors. So some of the bigger companies, Home Depot, Lowe's, Best Buy, some of the newer companies like a Wayfair, spend more and more time now really focused on how traditional retailers are embracing online commerce, bringing online commerce into their business model. But just for those of you not familiar with a sell-side equity research analyst, so our clients are basically money managers of all shapes. So hedge funds, pension funds, mutual funds, that type of thing. And basically, I serve as a consultant for those type of money managers on the names we follow in the broader consumer sector.
Great. My name is Simeon Hyman. I'm the head of investment strategy at ProShares, and we're one of those money managers. We're an ETF firm. We have about 160, 170 ETFs of various stripes, and we recently launched 2 thematic retail ETFs, cleverly monikered CLIX Clicks and EMTY Empty, and you can figure that EMTY does not have a bullish view on the brick and mortar space, but that brought me back to some things I hadn't thought about in a long time, because I was in Macy's training program in 1990, so that made me the expert.
And yeah, to kick things off, it's good bringing into that because, obviously we've talked a lot about the retail apocalypse coming out of 2017, a lot of retail bankruptcies, a lot of store closings. According to CoreSite Research, 7,000 store closures that year, and this year anticipating even more. What do you guys just think of the state of brick and mortar going into 2018, and what do you think of just this retail transformation going forward?
I guess I'll go first. We took a position several years ago that we thought brick and mortar retailers, if they did it right, could thrive online. And there are some that are, and then there are many that are not. One of the key facets of that analysis was flexibility. It takes a lot of money to build a website, and it takes a lot of time. And to expect a brick and mortar retailer to flip a switch and all of a sudden be Amazon Lite with its website is completely unrealistic. So one of the things that we focus on is the progress that they're making. And we've seeded online to Amazon. I don't think any one retailer will catch Amazon, but Amazon's not the only retailer selling online. So our view is that brick and mortar's got a place. 85% of retail sales are still done in a store. The stores are critically important to a brick and mortar retailer's existence. You can't starve the stores to spend money on your website, and you've got to integrate them. And that takes time. It's hard to build a second channel, hard enough to build a second channel without building it with an eye on how am I going to integrate this thing? Because that's what you have to do. You're not Amazon, you're not building a single channel where you don't really care about brick and mortar. You've got to find a way to meld the two. And there's really no one there yet, and that will be what we call omnichannel. There's no one quite there yet, but there are those that are making significant progress to getting there. Once they get there, you'll see profitability.
Right. And look, from my vantage point, I tend to agree with a lot of that. I think 2017 was the beginning of a turning point where we started to see a number of these a number of the larger larger traditional chains really start to fight back online. You know, we're talking this before we started this about Best Buy, and I think they're probably one of the best examples of a company that traditional retailer for a while was really in the crosshairs of Amazon and has now come out to the point with their own online operations or omni-channel operations, and they're competing very, very well. The other point I would make, though, and look, I'm a Wall Street analyst, so I tend to be an optimist. It's like in our blood. But I think, you know, if I take a step back and look at traditional retail, I think in a way, I'm going to say Amazon, but obviously that means all of online. But I think Amazon has been a big positive because in one piece of it, it's really helped to cull the herd. I started following retail more than 20 years ago, and at that time, the narrative was there's too many retail stores out there. And over the past 20 years, all these retailers have continued to grow and continue to expand. So if we were overstored 20 years ago, now we're really overstored. And so the online, so Amazon has really forced a lot of these less efficient companies now out of business. And then the other factor I'd say, and I make this comment even with like a Home Depot, is that Amazon's teaching these traditional retailers how to do things better. And I hear this a lot from these companies that, look, we're very, very good at what we do. But there's certain things Amazon does really well, particularly that which allows them to connect better with their customers. So, you know, we're seeing companies, I'm going to use Home Depot again as an example, that, you know, brings in that almost Amazon-like functionality into their traditional model. So,
Sure. Just a couple of thoughts. First, what we wanted to do at ProShares was just establish a couple of ways to measure the distinction between the legacy brick and mortar players and the online players, which actually is not as easy as you think it would be. So we created an online index and a brick and mortar index, and just looking at their performance as an example year to date, the online retailers are up about 15% and the legacy brick and mortar folks are down 3%. I know there's nobody who's clean here. Everybody's a mix of both, but making some reasonable rules. And if you look at the fundamentals, online retailers in Q4 generated about 30% earnings growth, and legacy brick and mortar players about 6%. So it's a big headwind. And two things I entirely agree with. Number one, it's really expensive for a legacy brick and mortar player to get to omni-channel. Number two, there will be some successes, but you gotta pick one of them out of the many that won't. So we think that the preponderance of the brick and mortar players are really going to be in significant pressure for a while. We're at 8, 9, 10% online sales now. Everybody thinks it's going to 20. And even by category, just consumer preferences are often 30, 40, or 50% by category if you ask people what kind of shopping they want to do and how much they want to do online. So early innings.
And yeah, taking that conversation from the brick and mortar side to the digital side, obviously, you know, as you're saying, e-commerce sales, you know, are growing, and obviously they're becoming a bigger share of total sales. Really, where do you guys expect this all going ahead as far as even the convergence of having both channels together and needing to have sides integrate, considering, like you mentioned earlier, I mean, most of the people in here are going to have both sides.
Who's going first? Well, it's pretty clear that everybody's going to do both. I mean, we know that. I mean, obviously, everybody in this room knows that Amazon buys Whole Foods, and every online retailer is, every brick and mortar retail is ramping up their online presence. And you know, there was a big success story that Walmart had materially increased their online sales, even beyond just the integration of Jet. But of course, the baggage that came with that were lower margins. The omni-channel effort, even if successful, is of course better than bankruptcy or extinction, but is probably not as good as what many of these legacy players had 20 or 30 years ago.
Right. And look, I think a lot of it, if I understand the question correctly, I think a lot of it's just going to depend on the category. You know, and from my vantage point, which again, I have a relatively limited window into the retail world, but you know, we've seen this. There are clearly categories. Consumer electronics is sold very well online. But other, you know, we follow companies such as, don't think of it, like a Tractor Supply, a unique retailer out there sells a unique product mix. They've now gone online. It's 2 to 3% of their business. You know, I think just given the nature of that product, given who that company serves, given the nature of their lifestyle they're serving. So I think you know, when you're talking about what ultimately is going to happen here, it's really very much going to depend upon the specific product categories. I think there's even over time there's going to be a very wide array of online penetration.
You know, just interjecting for a second. I mean, it always makes me nervous when people think of categories that might be sort of Amazon-proof or will perpetually never have much of a presence online. Because I remember when we all thought grocery would never go online, and the reason we all thought that 20 years ago was not because we all thought that people wanted to squeeze and smell their vegetables and all that stuff. It was because when you go to the grocery store, you're going into a warehouse and pick and packing your own things. And we all thought that the cost of actually delivering that to your house and having people pick and pack in a DC was so exorbitant that it would never happen. And now there's like a robot in London doing it very, very well. And the whole category, of course, as we know, is starting to ramp up online. So yeah, I mean, the odds that a huge proportion of Tractor Supply Company can go online overnight, probably not so high. But I just get worried when people say, that thing over there, never going to be big online.
Yeah, and I hear you. We've definitely seen examples of that, because it wasn't that long ago we were talking about the only things that would sell online would be books.
Yeah.
But, I mean, I'll believe it the day someone is redoing the deck in their backyard, and they have the whole deck, shipped to them. And again, there's always, and it was funny too, I had this conversation a lot with, a lot of our clients are New Yorkers, which I assume some of you are. We live a different lifestyle in New York. I think we've got to be cognizant of that. And what we do as far as our shopping habits are different than the rest of the country. And so I think that's also going to be a factor too, just kind of where we live.
Yeah, I guess when we look at the online universe, the elephant in the room is Amazon, obviously, but the biggest elephant in the room is the Amazon shareholder base. If you're a CEO running a retailer, the biggest problem you have is keeping your shareholders happy. Because to Simeon's point, your margins are going to drop. When you're investing online, you are going to take a margin hit. And Walmart demonstrated this in October of 15 when Doug McMillon standing at the stock exchange and says, we're going to make these investments, which we think are vital to our competitive position and will help us offset Amazon's threat, and the stock price gets crushed. Amazon, on the other hand, sticks a toe in the water, maybe, in a sector. Amazon stock goes up, the rest of the sector gets crushed, and CEOs sit there saying, what do I do? Because you're going to have to feel some short-term pain if you want to be competitive over the longer term in retail these days, and that's been going back for a while. You have to invest online, and you have to be able to explain to your shareholders, listen, these are investments. This is similar to what Amazon's doing. Amazon added $35 billion of debt to the balance sheet last year. Didn't really grow operating income all that much. If a brick and mortar retailer were to do a fraction of that, there would be absolute revolt from the shareholders. That, to me, is one of the toughest balancing acts that retailers have right now, is the largesse, I guess you'd call it, of the Amazon shareholder base, where they're fairly agnostic, completely agnostic to profitability at this point, and it's tough to, it's tough to compete with that.
And we can reserve the Q&A till after the panel. But yeah, to really go on to that, I mean, we look at measurements now, and we're looking at today's retailer, whether they deal with the online side or the physical side. And traditionally, everyone always thought about same-store sales. They thought about website sales or website traffic even, EBITDA. Really, where do you guys see a lot of that shifting? Or is there a shift as far as really how retailers should be measured?
We focus on operating income. We don't care how you get there, provided, of course, that you're not starving the company from an expense perspective to drive OI. But that's the thesis behind all of our ratings in retail. It drives our retail methodology. It drives our industry sector outlook. So margins are critically important at that point. I've never been a real fan of comp store sales just because there can be so much noise. I mean, I can remember when, and Brian remembers this as well, and Simeon will too. One year Neiman's were down 30, the next year they were up 30 during the recession. It's like, what am I supposed to do with that? You got to go back a few years to really make them relevant and see what was really going on. So I think for us, operating income is one of the purest forms of analysis. ROIC, that can get murky. I mean, try to calculate ROIC for Amazon right now, and then, I'll pay you heavily to give me your calculations because I haven't been able to figure it out. So we like operating income.
Right. Look, I agree with that philosophically, but I mean, as far as the way the stocks move, we can't do that. So it's when I think we analyze a company, comp store sales have always been a flawed metric, but they still move stock prices, so we pay attention to them. And now you basically see most companies meld together their store sales and their online sales to come up with a comp. So the definition of comp is changing. For stock prices, it still matters. When I really think of the health of a company, though, and again, and also tying that together with what moves its stock prices on a nearer term basis, it's really the combination of comp store sales and gross margins or gross profits. So we've tried from time to time. We tried to compartment or to package that, and it's very, very difficult because given the limited information we get from our companies. But it's basically a gross margin type comp that I think is the most important. So it essentially says not only is a company driving sales, but they're doing it profitably, at least at the gross profit line.
Yeah, there's kind of two roles for metrics. There are the metrics that investors think about in terms of the health of a company and valuing it, and how much the stock is worth, et cetera. And of course, there are metrics that are used for management purposes and decision making, and they're related but not exactly the same. And Lizzie and I were talking about before this panel. There was a famous Harvard case study on J.C. Penney from the late 90s. Nobody's going to remember this, but it was this great applauding of their use of satellite TV. Somebody remembers this. Thank you very much. And they were using satellite TV because the buying line had to first buy their stuff and then pitch it to the store managers, who then decided if they wanted to buy it and in what quantities and do the distribution. And so the genius thing was satellites was going to stream like this, which was totally upside down because it was moronic. Store managers should not be doing anything of the sort. As I used to say back in the day, you don't have to stand in Queens Plaza to see short people to know that you need small size shoes. So I bring this anecdote up just as we're in even more of a muddled mess that I think on the management side will be more of an impetus to more centralized decision because you can't untangle it at the granular pieces. So therefore, you're just going to have to use all these metrics as a management team and make a lot of centralized decisions that are doing your best to guess, how did that store do? Is there a bunch of online sale? Are people web rooming? Sure, like it's just too jumbled together, and it's going to be a real centralized decision challenge.
In today's, obviously at this conference, the focus is on innovation, and that is the central theme. And that's something that isn't always jiving well with shareholders as far as the short-term gains, as far as what can come out of it. A lot of it is long-term investments. How should retailers really go about approaching innovation, especially if they're public and they have that kind of pressure on them going ahead?
I think I made my point earlier very carefully. I mean, I literally sat in the back, and I don't know if Brian was there, at the stock exchange when Doug McMillon was standing on stage, and I have never seen thumbs move faster on devices in my life when he put the slide up and said, this is the operating income hit we're going to take over the next 3 years. You have to communicate, and that's probably the toughest job right now because the returns could be so murky, and you don't have a proxy out there to give you, well, here's the market leader online, Amazon. We don't know what their returns are, so we don't have an idea of how fast the payback's going to be. It's not like building 100 stores in a year where you can say, okay, in 12 to 16 months they're going to be four-wall profitable. We can figure all this out. We can back in and do all that. In this environment, it's almost like the Wild West. You're going to drill dry holes, and you just have to recognize when they happen, and you got to have the discipline to get away from them. And that's something that I think retailers are learning on the fly.
The one thing I would say from a public market perspective is the last thing you want to be right now is the retailer sticking its head in the sand. So I agree. I mean, there's clearly an opportunity to overinvest, to chase too many things. But I don't want to offend anyone here, but one of the companies I don't cover anymore, I covered it historically as Bed Bath & Beyond. So we, as a stock, as an analyst, I covered Bed Bath & Beyond. We always, one of the narrative on Wall Street for a long time was how great Bed Bath & Beyond was as saving cost controls. I mean, there's this really, expense-focused company, and they continue to drive sales. They essentially put their primary competitor in Linens and things out of business, all while not raising costs. Well, in my mind now, that's really coming back to bite them, because they did too much of a good thing and not investing. Now they're trying to, but they're in a position of significant catch up now. So I think I guess it's a happy meeting. The last thing I want to do is stick my head in the sand. If anything, I'd want to err on the side of being almost too thoughtful, too aggressive with investments.
Yeah, I think you put it very well, although I'll characterize it slightly differently. I don't think it's any sort of particularly benevolent thing about Amazon's shareholder base that they cut them slack. The funny thing about all these conversations, Wall Street's too short-term focused for me, but it's too long-term focused for the guy over there. I think that's kind of just a confusing way to just say that, look, people are, the market does evaluate long-term prospects. And the reason that Amazon gets cut slack when it makes an investment is that everybody's best get is it's going to ultimately pay off. And the reason that a mature business gets whacked when there's a short-term bump in profitability is because people are extrapolating that as indication that their business is weakening because they were mature anyway. So whatever happened this quarter is probably indicative of secular decline. So the shareholder kind of constituent effect, I think, is an interesting way to look at it. But more, I think, just the market's making some best guesses of long-term prospects. And to that point, you got to do what you got to do what you think is right. And if you communicate it effectively, and people do think that there is a vision to whatever omni-channel investment you're making or whatever stores you're closing, then you cross your fingers and hope in the near term there's a reasonable reaction, but more importantly that the results show up even if it's 6, 8, 10, or 12 quarters later or more.
I'm hearing to your point, I'm hearing probably my smartest companies now, I think they got this term from Silicon Valley, but fail fast. So that's new for traditional.
old one.
I haven't heard that from traditional retailers,
Yeah.
from besides the last couple of years. But it's look, we're going to try stuff, but we know when to pull out of it too. So your drilling hole analogy was.
I mean, one of the things about Amazon is you can almost look at Amazon in some ways as a laboratory. I mean, they're experimenting with a lot of different things, and some are going to work, some aren't. The phone didn't work, but did it? What did the phone beget? Alexa and the Kindles and everything else that's driving the Prime membership. I use a similar example when Apple came out with the Newton centuries ago and it failed. But where did that technology end up? In the iPod. And that begot the iPhone and the iPad. So sometimes when you fail, you don't fail. You may fail today, but tomorrow you'll be very successful with the same kind of construct.
And at the end of yesterday in our closing keynote, Casey Lobaugh of Deloitte brought up a report that Deloitte came up with regarding this concept called the Great Retail Bifurcation, in which we're seeing more of a divide between low-income shoppers and high-income shoppers and how they spend and why they spend, with the low-income, naturally going for the value with high-end focused on experience retailing. Where do you see retailers having to focus if they're going to have to focus on either of those type of consumers?
You go.
Let me think about that for a second, because I know these reports are always really interesting, in talking about this bifurcation. But tell you, we don't necessarily. From my vantage point, I don't necessarily see that play out for any length of time. If someone were to ask me right now, what's stronger, the high-end consumer or the low-end consumer? I don't know if I even have a great answer, because I would say what should be on a second derivative type basis, or what should be, it should probably be the low-end consumer, just given maybe the benefits of some of the personal tax cut, coming from 2007 to 2018, blah blah blah. But I'm not necessarily seeing that in the results. So if I think about it maybe from that standpoint, from a retailer, the only thing I can think of is for the retailer that serves that really low-income consumer. Those retailers probably have to be more cognizant of keeping their prices really low, so any investments they're making online can't impact that. So maybe retailers that serve a higher income consumer charge higher prices, maybe can be a bit less cognizant of that. I don't know if that's, you guys want to chime in?
The only observation I would make, and this is not super core to the things I do every day, but if you're going after the high-end experiential customer, we used to say that any retail idea had about a 20 or a 30-year lifespan to it. But if it's an experiential high-end one, it's like a movie. That thing's going to have a 5-year life to it. So, it might be right. And of course, some differentiation is the only way you're going to get pricing power. But boy, it's hard to do something for decades in that space.
And talking about income and really being able to transition, obviously the end of 2017, we saw a big change as far as tax reform. And that was something that obviously is going to affect everybody. It's going to affect retailers and consumers alike. Really, how do you anticipate that with retail in 2018 and beyond? And really, how do you feel like retailers should be focusing on the freed up money they may have?
Well, listen, I'm a credit analyst, so balance it out. Invest some, don't send it all back to shareholders, but invest some in the business. You have to invest. I mean, we're in a period now where retailers always needed to invest, but now there's such a premium on it. You have to invest in your stores, you have to invest in your online business, so there's got to be some balance. And then you're going to be investing in price, because let's not forget, right now we're in the middle of I call it Ali Frazier between Amazon and Walmart trying to get market share, and they're using price to do it. And there's all sorts of derivative and collateral damage down the road. So if you're a retailer, I wouldn't assume that hey, I won the lottery, I can spend it. I would say investing a good chunk of it is the way to go.
Right. And you had a couple questions. When I start answering questions about tax reform, I usually segment it to the individual and the corporate. So I'll focus on the corporate side, because what I think we've seen is, so late last year when corporate tax reform was announced, and I think it surprised most people, most companies, there was this wave of announcements from leading companies, big companies, talking about some of the one-time bonuses to employees, maybe some wage increases, in some cases some investments, stepped up investments. Okay, so now we're a quarter of the way, a little bit more, a quarter of the way through 2018. A lot of our companies are now starting to report their fiscal Q1 results. That rhetoric is dying down significantly. If we do the number, if we just simply do the math, okay, how much these companies are saving by their effective tax rates going from 38% down to 21, or 38 to 25, probably 38 to 25, versus what they've committed to invest, whether they're employees or investments, there's still a lot left over. And I think what's going to happen, from a stock, I'm looking at it from a stock perspective, I think we're just going to see quietly a lot more buybacks.
Yeah, I'll take the bearish side of this one, and it's the invest in price comment that I think is core here. I mean, by first principles of freshman economics, a price cut in a tax cut in a perfectly competitive industry does not accrue any benefit to companies. It just goes to price. It could also go a little bit to wages and input stuff. So I think there's this window, before that may take, many quarters, even a couple of years to kind of completely disappear. And one of the things that happens in a competitive industry is you get a little bit more investment. So you'll be a little bit more investment, returns will come down, and ultimately it won't be a big profit driver over the long term. So I don't think there's a huge residual left. Now, there is a macro effect that's a good story. And this is weird because we're having a big fiscal stimulus and a big deficit spending very, very late in the business cycle, so it's a little uncharted. But to the extent that it stimulates the economy a little bit, and the extent that particularly lower income people have a little bit more money, that in and of itself can be a macro tailwind to retailers, but I'm still quite skeptical of a sort of primary benefit just from the cut of the marginal tax rate.
Great. Well, on that note, that actually opens us up to Q&A if anyone has any questions.
Hi, so you guys talked a lot about investment in the stores, and a wave of companies have been talking about, 800 stores here, 500 here that they're really investing in. And I wanted to hear your opinions on who you've seen doing it well, and if there are any segments of the stores that you think are most valuable to focus in, be it like checkout or BOPIS or making the stores pretty or whatever the thing may be that you think is really returning the most value for some of these retailers.
I would say Best Buy. 5-6 years ago, Best Buy was allegedly roadkill. And, Hubert stepped in with his new team. They tweaked an already solid operating strategy and freshened the stores up, made the stores attractive enough that Samsung and Microsoft and Sony and a bunch of other big vendors chose Best Buy as their brick and mortar partner. And now you've got these great vignettes in the stores. They were able to cut an optimal store from 55 to 40,000 square feet. It doesn't look any different. So they were able to leverage the real estate. The stores are fresh. Again, they've got the buy online pickup is in the right spot. It's in the front of the store. There was, at the beginning of this kind of exercise, some retailers are putting it in the back, so you have to walk through the store. Maybe you buy something else. Like, wait a minute, I got to walk all that way to get my stuff. I don't want to do that. I want it up front. Then put the stuff right behind it that you're going to try to cross-sell me. So I think Best Buy's had a really good run. Walmart does everything really well. Target is on the right track with its stores. But I would put Best Buy at the top of the list of the companies that I cover.
I totally agree with Best Buy. I mean, when you were asking the question, all of what's going through my head was Best Buy. I mean, look, not to make it, there's a lot of really neat things going on out there, these stores. I hear some really kind of wacky stuff, but facial recognition. Look, I think, at the end of the day, not to oversimplify this, but you've got to be matching online on price with your store price. Okay, so then you're in the game. You have price, and then you've got to have great service, and that's exactly what Best Buy's done. I mean, it wasn't nearly that simple for them, but their service in their store matters, and I think that's the same case for like a Home Depot, is that it's that people actually. Consumers want to come to the stores because they're getting service and they can't get that online.
I just want everyone to know it's not my fault that the Best Buy pickup used to be in the back of the store, even though in 1998 and 99 they were my client, and I just mentioned that the Sears catalog return was in the back and milk was in the back of the supermarket, so it wasn't my fault. But we're index folks, so we don't do a lot of sort of commenting on the granular companies anymore.
So I wanted to go back to your comments on Amazon and the Amazon shareholder giving them the benefit of the doubt, and most retailers just don't get the benefit of the doubt. And I'm wondering do you see that changing with the Whole Foods and with some of the work that Walmart's doing with, and what Walmart's doing with their innovation lab and what they're doing with grocery, and because and then just address this. At the Amazon shareholder, what are they seeing in Amazon 3, 5, 7 years out? Or are they just not really discounting back the future values to today? Because
Marie, I think, okay, what are they seeing? I'm a fixed income analyst, and I'm looking at credit statistics. I'm looking at a lot of investment, a lot of debt on the balance sheet. Earnings haven't come yet. I mean, this is a decent quarter, Q1. I don't know what Q2 is going to be. My Ouija board does not tell me what Q2 for Amazon will be, much less full year 2018. It's really hard to dimension because you don't know what the investments are going to be, and you don't know where they're going to make them. There's so much opacity with respect to Amazon's reporting, and I get it. I mean, it's a tech company. There's a fair amount of concern about competition. But I think that what Amazon has been able to do is, and I don't want this to sound pejorative, but they've sold a lot of sizzle over the last several years. And I heard one equity analyst, and I'm not going to call anybody out, explain a price target of 18 times 2018 EBITDA. And I was sitting there, and you know who it is, and I was sitting there in Q3 2017 saying, I can't calculate Q3 2017 EBITDA. I don't know how you can go out that far. There's a perception that, the 30+% operating expense level that used to be 23 or 24 5 years ago can reduce back to that level. I don't know that that can happen because I don't know how much of the consumer experience and that sales growth and Prime membership is embedded in that higher expense level. I don't know that they have to maintain those expenses to keep the top line growing and keep their Prime members happy. I just don't know. So that's the biggest problem for us is predictability. Investment grade retailers, I've been at Moody's for 15 years and I've covered pretty much every investment grade retailer we've had during that period. There's a fair amount of predictability with operating performance. And in the case of Amazon, and I've been around Amazon since the late 90s, there isn't any. I mean, I don't really have a clue what 18 is going to look like. I know they're going to invest heavily. Are they going to add another $35 billion of debt onto that balance sheet? I don't know. Whole Foods was, in our minds, a recognition that the food business wasn't scaling fast enough with just an online presence. And we're in the camp that we don't know that food delivery per se will be a huge driver in the grocery business. Buy online, pick up in store makes a hell of a lot of sense to us. But the absolute delivery part, unless you're in certain areas of the U.S., highly populated, Brian made the point, we're in New York. Here, yeah, all day long. Fresh Direct can thrive here. Amazon can thrive here. Topeka, Detroit, where I grew up, I'm not so sure. So the jury's still out on all that stuff. But I'll go back to when I talk to retail CEOs, and that's part of what we do, to a person, they sit there and they say, why can't I get the same break from my shareholders that Amazon gets when I invest? When I'm building something and you already know what I have, and there's some more predictability to what I will be able to do going forward, you don't really see that out there in my mind.
I totally agree with that whole thing. I mean, it's, I mean, it's just, I know it's a very, very hypothetical exercise, but if you were to take what Amazon reports, and I'm not taking it away from Amazon, because clearly there's been a lot of success there, okay? And like a comment I made before, they've taught a lot of my traditional retailers how to do their business better, okay? A lot of success. But if you take their results and put them in a company, even like a Home Depot, which is a phenomenal retailer, you would get a completely different response in the market. Amazon has a halo around it.
Yep.
Well, all you can do is just look for some short-term signs. So what, they just jacked up the price of Prime. So if they don't lose customers, okay, at least there's a little sign that in the long run we're all dead, but in the long run Amazon does have to turn a profit. So all you can do is look at pockets of quasi-maturity and see if at least those pockets, if to the extent you can isolate them a little bit, are starting to go into the, not just the green on a P&L standpoint, but return on capital as well.
Great. Well, I believe.
Yeah, so a question on just with all the headwinds the retail industry is facing and need to go on, omni-channel, upping digital presence, et cetera. Does that portend anything in your minds in terms of deal activity, M&A, and can you speak about maybe a non-mainstream investment thesis in the M&A environment?
Well, thinking about my group, hardlines retail is largely whittled down now to a collection of subsectors that are, for the most part, two players, maybe in some cases one. The one category, again, just in the group I cover, that has stayed more than it's auto parts. But I think there you have a dynamic where O'Reilly and AutoZone both really don't have an interest in buying Advance Auto Parts and would rather just feed off the market share that Advance Auto Parts cedes quarter in, quarter out. So the advantage, from my vantage point, from a physical retail standpoint, I don't see much consolidation happening from here. Now, I think most of my retailers now are on the prowl, if you will, for digital capabilities. And so whether any deals like that would actually be of size is hard to say. We saw, this is obviously a private company, but like a PetSmart buying Chewy. I think that was, again, they did it in the private realm. Maybe it probably would not have happened in a public market, okay? But I mean, that's pretty clearly PetSmart saying they're way behind the curve on online commerce. They go out and buy Chewy, and they pay a ton for it. Obviously, Walmart buy Jet, and that launched their significant, that we've all been talking about, this significant online effort at Walmart. I don't know. I mean, I could see. I mean, I guess the answer, I could see some smaller technology type deals, but I have a hard time seeing anything really significant as far as consolidation.
Yeah, I cover the auto retail space, the dealers, and I also cover the auto parts. I echo what Brian was saying about the parts guys. But the dealer side, I think, has been consolidating. It's a roll-up. Everybody's on the prowl looking at the same assets. The only thing holding back further consolidation there is valuation. We've come off, 17.5, almost 17 new car sales. So dealers that may have been willing to sell for X, 4 or 5 years ago, now want X squared. And the buyers are sitting back and waiting. But that's one sector that, I could see a lot of activity, and we have seen it. I mean, there have been some pretty decent-sized, billion-plus deals done in that space over the last 3 or 4 years. I think that continues.
Great. Well, yeah, that about wraps it up. But thank you three so much for
Thanks for having
attending
me.
and for talking. And thank you all for attending.
Thank you.